This is the show the Real Vision community has been asking for. 3 ideas. And exactly like the title suggests, an expert comes in and gives you 3 ideas about where you can put your money right now. It's not trading advice, but it is a starting point for you to do your own research. We're showing you a sneak peek, but click here to subscribe and get the rest.
I think all these you could hold for 5 years. There could come a time when the precious metals have run up substantially, and these things are not cheap anymore. And at that point in time, I could see that happening 3, 4, 5 years out. At that point in time, they would not be as compelling as they are right now. But I think right now they're quite compelling.
Larry, thanks so much for being on the first episode of 3 Ideas. And before we get to those 3 ideas, I just want to get your global macro outlook. We're coming off of big announcements from central banks, not just in the US or the Bank of England here in the UK, all around the world. So tell us what that means for this industry at large and the industries that you look at.
Yeah, first, Samuel, I'd like to thank you for having me on your show. I'm a big fan of Real Vision, subscriber. Yeah, the global macro, right? What a mess. It's extremely volatile, and I don't think we're in uncharted waters, and nothing new there. My belief is that what we're slowly seeing is a change from a system where the central banks could control everything to a system where the central banks are not going to be able to control everything. And I describe it as kind of monetary chaos, and we're gonna swing back and forth between high inflation and the risk of deflation. And so, this is the problem that the Fed is faced with. And as we all know, they've kind of packed themselves into a corner right now. And with that as a backdrop and understanding the way that, democratic and other governments work, my belief is that they can never stop printing. And although they may be trying to right now, and for some time they will, eventually the damage and the pain that's going to cause are going to force them to go back to where they were before. And that's because the system is built on ever increasing credit, and the alternative is a deflationary depression. And so, although we're in what would look like a deflationary impulse here, a very big one, I think that there'll be a time when they'll have to change policy because the conditions will demand it.
And Larry, when you say the system which they used before, what do you mean specifically?
Well, I mean the monetary system. The way we've constructed our monetary system using leverage on leverage, and the way the governments operate using continual growth in sovereign credit. And so what we're really encountering right now, in my view, is a sovereign debt crisis. It's the bursting of the everything bubble that got created. It all was kicked off when they went to a ZIRP, 0% interest rates from '08 to '15. I mean, that was a crime against, capitalism in a sense. If you don't have an interest rate on the money, then the money has no value intrinsically. And so it led to all kinds of capital misallocations. And now we're seeing the effects of that policy come home to roost on all of our assets. And it's what's making the environment incredibly difficult for all investors, sadly so. But you can't undo. I mean, what I see is very similar to what happened in '29. I mean, people say, well, I don't want to have a bust. Well, okay, you shouldn't have had the boom, the big boom that was created, NASDAQ up 16x from '09. I mean, it's got to be corrected. And, there are implications, right?
This is all crystallized on a tweet that you have pinned to the top of your Twitter account. 2 simple lines. One says gross domestic product. The other one, all sectors, debt, securities, and loans, liability level. I think you've made it pretty clear why you've had that tweet pinned up there since then.
Yeah, that's right. I mean, it's you cannot increase debt forever because you can't service it. And so we were in a big deflationary period for the last 40 years. And I think that ended on March 2020. I mean, you had, the 10-year was at 43 bips. I mean, my view is that we are now in a new world, in an inflationary environment, and that it will only continue to grow, the inflation that we currently experience, which is not to say there won't be periods when it slows down. I mean, I think it's going to be very volatile in both directions. It's a treacherous environment for investors, but the things I conclude pretty solidly are that bonds are a bad place to be, and that over time, I think commodities and equities that are equities tied to things will do better than equities that are tied to growth and ideas, because I think we'll be in a stagflationary period, and there will not be a lot of growth, and that's my belief.
So that's how very clearly your global macro outlook. But
Right.
how does that apply to the industries that we're about to talk about?
Yeah, if you look at it, so the conditions I think are going to be very similar to the 1970s. I was a teenager at that time, and in those conditions, the bonds were just a total disaster. I mean, there was no worse investment than bonds. Equities were very choppy. They were pretty much a disaster. I mean, you kind of held your purchasing power, but barely. And the areas that did extremely well were commodities. I mean, the two top performing industry categories in the 70s were the oil stocks and the gold stocks. And of course, I focused on the gold stocks, and that's the reason why. My macro outlook informs me that gold stocks, I think, will be the top performing asset category in the next 10 years.
I mean, I've been looking into these companies that we're about to that we're about to discuss. And as I look at them, it seems like they maybe all are in a similar space, in part because of what the Fed is doing right now. So, where do you see this entire industry inside that global
Yeah,
perspective?
well, so to to give you some context, gold did extremely well, and the gold stocks did extremely well in 2020 as a result of the money printing and the inflation that was going on. The Fed was at the time quite accommodative, and that was very beneficial to assets which take advantage of the inflation. So they reflected the inflation that we're now experiencing. They could see it. As we all know, the Fed has now decided to try the Volcker playbook, and so the theory is that they're going to get inflation under control. Inflation is going to come down, and you don't need gold, and you don't need gold stocks. That's the theory. I think the reality and the practice is that they're not going to be able to control inflation. That ultimately their activities are going to cause something to break, and that when they do, they're going to have to come back in with more money, and there will be more inflation. And so the bet we're making is, in my opinion, that the central banks will not be successful in what they're doing. But to your point, where we are right now, we've just had a huge drawdown in the gold stocks. I mean, my fund was up 98% in 2019. It was up 122% in 2020. I've given half of that 2020 run back throughout 2021 and 2022. So, these things are volatile, and basically, when you're looking at these assets, they react to what they think the future price of gold is going to be. They're leveraged bets on gold. I mean, you could just buy gold, and gold, people knock it, but it's actually one of the better performing asset. Other than cash, it's probably the best performing asset category this year. I suppose some commodities have done a tad better, but bonds are down 20%, stocks are down 20%, gold's down 6% year to date. We're in a correction, I guess, is the best way of saying it, and therefore I think our video here is rather timely in the sense that I think people who buy gold stocks right now, almost irrespective of which ones, are going to be pretty well rewarded as we enter the next upwave of inflation. And I think that's coming. I don't know when. We talked about this pre-show. It's impossible to know when, but I think it is coming.
Larry, let's get into the three ideas. Let's start out with your first pick. That's Equinox Gold. This is a Canadian company, dual listed on the NYSE, EQX there. Tell me about the company, but also tell me from the get-go, I assume that you have exposure to this company. You're invested?
Yeah, I have exposure to all three of these ideas. Obviously, this is what I do. My people pay me to pick the best names, and I've tried to pick the safest, largest names, and then two of the safest, largest names, and then one that's a little bit more speculative, but I think quite safe or good. The first one's Equinox. So this is a $1 billion market cap company headquartered in Toronto, based in Canada. Ross Beatty, who's kind of a mining legend, a billionaire built on mining stocks, is the chairman and owns 8% of it. So that's always a nice thing. And I think they have one of the best management teams in the business. And that's extremely important in this area because I should say gold mining is a difficult business. You're breaking rocks and Murphy's Law applies. And there are a lot of things that can go wrong. And sometimes they do. It's just a matter of how it works.
I mean, if we take a look at this company, it was trading at $8.90 back in April, and now we're trading somewhere around $3.50.
Right. So to me, it's an incredible bargain at these levels. It's just, and this is a reflection of the macro that we were speaking about earlier, right? I mean, everyone thinks that the Fed will be successful in containing inflation, and therefore you won't need gold stocks. I personally think everyone's incorrect in that assumption, but obviously that's why they're markets. So these guys are based in Canada, and they have 7 producing mines, and they're in safe jurisdictions, and that's important too. I mean, when you're picking gold mining stocks, there's some companies that operate in countries that are not friendly to gold mining or that can seize mines or tax mines. And so I think Ross has been rather smart here. He's his portfolio of companies is in the United States, Canada, Mexico, and Brazil. So, in my opinion, those are all safe countries, even though South America is a place where, well, there are others, but South America is one of the places where there's some countries that are uninvestable, in my opinion. And so he's got 7 operating mines, and then he's got 4 growth projects and expansion in those existing mines. And I think the most interesting thing here to me is, to me, the lowest risk category of investing in gold stocks, and they're really 3 buckets, right? They're the producers, they're the developers, and the drill stories. The producers are the safest because they have positive cash flow. When you have positive cash flow, you can't go bankrupt, right? The development and the drill stories, they all need to absorb cash to hopefully produce gold. And so this is a producer. In this year, they should have $250 million of EBITDA with a market cap of $1 billion. That's 4x EBITDA. That's not bad, right? Compare that to Apple or some of the others out there. But more importantly, and as I was saying, I think the lowest risk category are producers that are growing, because you could buy Barrick or you could buy Newmont. The problem they have is that they have 5 million ounces a year of production. And remember, a gold mine is a wasting asset. You're pulling gold out of the ground. Once you've done it, it's not there anymore. You got to find more gold. So, it's like being an oil company. You're always looking for new resources. So you're always exploring. And in my view, when you're smaller, it's easier to replace what you mine, because if you're Barrick or Newmont, it's hard to find 5 million ounces of gold a year. They're barely managing to do it in some years. They're not in others. In this particular case, Equinox has been able to grow their resources very nicely. They currently have all category resources of 30 million ounces of gold. That's pretty interesting, because if you take the market cap, divide by 30 million, that means you're paying $33 for every ounce of gold in the ground. Now, if they were above ground, they would be worth $1,700. Obviously, the difference is you got to spend money to mine them. And so, the thing I think that they've done a nice job with here is they've got a nice basket of assets, and they've got a nice growth pattern. This year, they'll mine 580,000 ounces of gold. And next year, a few years out, I think they're going to get to close to 1 million ounces of gold. So that's 40% growth in the underlying gold that they're mining, and that's unusual in this industry. So this will, projected Bloomberg consensus projected EBITDA in 2024 is $500 million. So that would imply that they're selling at 2x 2-year out EBITDA, which is pretty cheap.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.